Welcome to the explainer. When you see a massive skyscraper, have you ever wondered how its value is actually tracked on the books? It's not just about what someone might pay for it tomorrow. Nope. Today, we're going to unlock the financial story of a building and get into the surprisingly strict rules that tell us what it's officially worth year after year. Okay, let's dive right in with a super practical question. Imagine you just bought a building for, say, 40 lakhs. Fast forward 1 year, what's it worth on paper? Now, you might think it depends on the real estate market, right? But here's the thing. The answer has nothing to do with market fluctuations. It actually comes from a very specific accounting playbook. So to get that answer, we've got to understand the financial story that accountants are actually required to tell. They follow a rule book, and it's called the cost model. This model pretty much dictates exactly how a property's value gets recorded over its entire life. At its heart, the cost model is actually pretty straightforward. You start with the price you paid, the original cost. Then every single year, you systematically reduce that value on paper. Why? Well, to account for things like general wear and tear and just plain aging. That whole process is called depreciation, and it gives us a really consistent, predictable way to track what an asset is worth on the books. All right, so let's get back to our building. Time to actually calculate its value after year one. You could say this is the very first chapter in its financial story. Okay, here are the key numbers we need to work with. First, the purchase cost, 40 lakhs. We expect it to last for about 20 years. But look at that last item, the residual value. What is that? Well, it's what we think we could get for the building's scrap parts after those 20 years are up. And trust me, this little number is a huge piece of the puzzle. Now here's the first big rule, and it's absolutely crucial. We don't depreciate the full 40 lakhs. And you might be asking, wait, why not? Well, it's because we expect to get those 2 lakhs back at the very end. The rules are clear. You only account for the loss on the part of the value that actually gets used up. And that brings us to a really simple 3-step process. First, we'll figure out the total amount that can be depreciated. Then, we'll calculate how much that is per year. And finally, we'll get our new book value. Let's just walk through it one step at a time. Okay, step 1 is easy. We take that original 40 lakh cost and just subtract the 2 lakh residual value. Boom! That leaves us with 38 lakhs. So this 38 lakhs figure has a special name. It's called the depreciable amount. The best way to think about it is this. It's the real on-paper cost of using the building over its entire 20-year life. Moving on to step 2. We take that 38 lakh depreciable amount and we just spread it out evenly over the building's 20-year life. So 38 lakhs divided by 20, that gives us an annual depreciation of 1,90,000 rupees. And that's it. That's the magic number for how much value our building loses on the books every single year. And just like that, we're at the final step. We've got all the pieces. We're ready to answer our original question. What's the building worth on paper after year 1? And here it is. We take the original cost, 40 lakhs, and we subtract that first year of depreciation we just figured out. The new official value on the books, what accountants call the carrying amount, is 38 lakhs and 10,000 rupees. Simple as that. But, of course, a building's financial story doesn't just stop there. I mean, life happens, right? What happens when you decide it's time for a big renovation or a major upgrade? How in the world does that change the numbers? Let's imagine you spend 5 lakhs to rip out the old interior walls and put in some brand new ones. Now, obviously that adds value, But how do you account for it the right way? You see, you can't just tack on 5 lakhs to the current value. That would actually cause a whole new problem. This is where the accounting standards get really clever. They have a very important rule for this exact scenario, and it's all designed to stop one specific, very logical error, something called double counting. So here's how they solve this puzzle. It's brilliant. You add the cost of the new part, right? So plus 5 locks for the new walls. But, and this is the key, you also have to subtract the value of the old walls you just tore out. For this example, let's say the remaining value on the books was 1 lock. And this gets right to the heart of why this rule exists. It makes perfect sense when you think about it. You can't have the old walls and the new walls on your balance sheet at the same time. One replaced the other, so their value on the books has to be replaced too. Okay, let's run the final numbers on this. Let's say a few years have gone by, and our building's carrying amount is now down to 32 lux. We add the 5 locks for our shiny new walls, then we subtract the 1 lock for the old ones we got rid of. And there you have it. The new carrying amount is 36 locks. It's basically just a clean swap. So let's just wrap up the main mechanics here. It really boils down to 2 fundamental rules for the cost model. First, you only depreciate the part of an asset's value that actually gets used up over time. And second, when you replace something, you've got to add the new cost, but subtract the old value. It's all about avoiding that double counting. So, at the end of the day, why does any of this matter? Well, it's because these rules are designed to make sure a company's financial reports tell a disciplined, logical story. They're not just random numbers. It's about providing a consistent and fair picture of an asset's value. But that leaves us with a big final question to think about. How well does this neat and tidy accounting story really line up with the messy, chaotic reality of the actual real estate market?